So, you clicked on this video because you want to know what equilibrium is really about, right? In this video, we'll be taking a closer look at the equilibrium concept in binary options. And today, I'll be explaining exactly what it is and how you can incorporate it into your trading. Trust me, it's a game changer and 100% worth learning. By the end of this video, you'll have a clear and thorough understanding. So let's get into it. Hey guys, before we dive deeper into the video, I want to personally invite you to join my free Telegram trading community, where I provide free signals, in-depth market analysis and insights, and tons of high-quality educational content to level up your trading. The best part is, it's 100% free to join. No subscriptions and no hidden fees. If you love it, you can stay and grow with us. And if it's not for you, you can leave at any time. There's no hard feelings. The link is in the description below or pinned in the comment section. So come and join the several hundred traders who are already in the group. Let's get back into the video. We are going to start off by asking ourselves, what is equilibrium? Equilibrium is an unbelievably powerful retracement tool that helps us identify premium and discount zones, exactly where banks and institutions love to open trades. Right now, we're looking at a clean example of an equilibrium range. An equilibrium range consists of a premium zone at the top and a discount zone at the bottom. And wedged in between these two zones, we've got the 50% mark in the middle, which is considered equilibrium. Now, the premium zone is an ideal zone for traders to sell, and the discount zone is an ideal zone for traders to buy. And throughout your trading journey, you've heard the saying, buy low, sell high, and that applies to equilibrium. Buying low, which is buying at a discount, and selling high, which is selling at a premium. Ladies and gentlemen, that's exactly what banks and institutions love to do. They enter trades at the best possible prices. The big boys will look to buy at a discount and sell at a premium. And us as retail traders want to be trading with the banks and never against them. Equilibrium is extremely effective when trading in trending markets. And right now we're looking at an example of an uptrend. Price is forming higher highs and higher lows. So in other words, this is bullish market structure. And when the market is trending to the upside, price doesn't just keep going up forever. What goes up has to come down. Therefore, we can use equilibrium to catch those pullbacks. So how do we measure equilibrium? As you guys know, equilibrium is a retracement tool. So therefore, we can use the Fibonacci retracement tool to measure equilibrium. We've already established that market structure is bullish. Price is moving to the upside, so we're automatically going to look for buys. Now, the next thing we need to do is identify a swing high. And right here, we have a swing to the upside. So what we're going to do is mark out the bottom of the swing with our Fibonacci retracement tool. And we're going to drag it all the way to the top of the swing. Keep in mind, how you've marked out your Fibonacci retracement doesn't actually matter. The most important thing here is that you've marked out the whole swing from top to bottom, or from bottom to top. Oftentimes, you will find with a swing to the upside, price loves to pull back to the 0.5 retracement level on the Fibonacci, which is equilibrium. Now, just be aware that there are no guarantees in the market. What we are talking about are very likely outcomes. Now, if we go ahead and recap real quick, we know that below the 0.5 retracement level, we've got the discount zone, and above, we've got the premium zone. And in an uptrend, we're looking to buy low. We're looking to take buys below equilibrium in the discount zone. And if we look closely here, after price formed this swing to the upside, we got a pullback below equilibrium into the discount zone, which would have allowed us to stock up on some buy positions before the continuation back to the upside. I mean, we can keep going here. Price forms a higher high right here with this swing to the upside. So we can go and grab our Fibonacci retracement tool, mark out the bottom of the swing, drag it all the way to the top. And as you can see, we get a pullback below the 0.5 retracement level into the discount zone, which gives us another opportunity to stock up on some buys for that very likely continuation to the upside. And you can keep going, catching those pullbacks in an uptrend, buying at a discount. That is the whole idea of using the equilibrium tool in an uptrend. Next up, we're going to take a look at downtrends. Everything we've covered up until now applies to downtrends as well, but just the opposite. Right now, we're looking at an example of a downtrend. Prices forming lower lows and lower highs, which tells us that this is bearish market structure. So, step one, we've identified the downtrend. The next thing we need to do is identify a swing low. And right over here, we have a swing low. So we're going to grab our Fibonacci retracement tool, and we're going to mark out the top of the swing, drag it all the way down to the bottom. In this case, we're in a downtrend, so we're automatically looking for sells. We want to see a pullback above equilibrium into the premium zone so that we can essentially sell high. And in this example, after price formed this swing low, we got a retracement above equilibrium into the premium zone, allowing us to stock up on some sell positions before that continuation back down. Again, we've got this lower low right here with price forming this swing to the downside. So I'm going to grab my Fibonacci retracement tool, mark the top of the zone, and drag it all the way down to the bottom. And once again, after forming this swing low, we get a pullback above equilibrium into the premium zone, giving us the opportunity to look for some sells before that very likely continuation to the downside. I can go on. The whole idea around trading in a bearish market is to catch those pullbacks and sell high. In other words, selling at a premium. So we've just done a little deep dive into trending markets. What about consolidating markets? Equilibrium can be used in consolidating markets. Here we have a prime example of consolidation. We're not trending to the upside, nor are we trending to the downside. Price is moving sideways. Every single asset goes through a phase of trends and consolidation. Now, trading in consolidating markets is very, very simple. We can clearly see here we have a swing to the upside. So I'm going to grab my Fibonacci retracement tool, mark out the bottom of the swing, and drag it all the way to the top. And because the market is consolidating, we can drag this all the way across the range. The reason why we drag the Fibonacci across the range is because price is bouncing up and down in this range, allowing us to catch some great moves. So basically, we'd be looking for buys when the price drops into the discount zone, and we'd be looking for sells when the price pushes into the premium zone. And we can keep doing this back and forth as long as the price continues to consolidate. But beware, trading sideways markets has its risks. At any point, consolidation can be broken with the start of a new trend. I mean, overall, personally, I prefer trading in trending markets because I find there's more sustainability and longevity. Whereas with sideways markets, in my experience, there's a lot of unpredictability and potential fake outs. At the end of the day, you can use equilibrium in all types of markets, uptrends, downtrends, and ranging markets. But yeah, that covers the ins and outs of equilibrium, the nitty-gritties. You guys now know what equilibrium is, how it works, and how to identify it. So what we're going to do now is head over to the charts, and we're going to take a look at some real chart examples. So let's get into it. We've just jumped over to Pocket Option, and we're on the charts as we speak. One thing you guys have to understand about equilibrium is that you can use it on any time frame. Now, the lower time frames, ranging between the 5-second and 15-minute time frames, tend to have a lot of noise, and you'll often find that your equilibrium setups will fail. Whereas the higher time frames, ranging between the hourly to the daily time frames, have a lot less noise, and you'll often find that your equilibrium setups will be far more reliable. So I strongly recommend sticking to the higher time frames when using the equilibrium tool. The hourly, the 4-hour, and the daily. The hourly being the lowest time frame that you use, and the daily being the highest. Anyway, what we're going to do now is take a look at a couple of examples of how we can use and apply equilibrium on the charts. Okay, so we're going to start off by taking a look at some examples in an uptrending market. Right now we're looking at AUD/USD on the 4-hour time frame. And as you guys can see, AUD/USD is in an uptrend, creating higher highs and higher lows. So we can establish that this is bullish market structure. If we look to the left, you'll notice we get a beautiful swing to the upside, breaking structure, confirming the uptrend. So what we're going to do is grab our Fibonacci retracement tool, and I'm going to change the color to white just so that it's easier to see. And we're going to mark out the bottom of the swing right here, and we're going to drag it all the way to the top. Now, after price formed this swing to the upside, it eventually became exhausted, started to consolidate before dropping back to the downside below the 0.5 retracement level into the discount zone, giving us the opportunity to look for buys. When price drops below equilibrium into the discount zone, you're not going to recklessly open buy positions because that's amateur. You ultimately want to be smart about it. The key here is to combine equilibrium with multiple confluences. I mean, in this example, I've just marked out a fair value gap with this blue rectangle. And down here we have an order block that I've marked out with this yellow rectangle. And you'll notice price drops down, fills the fair value gap, and taps into the order block. And that, people, is already 2 confluences. From here, we can drop down to a lower time frame, like the 5 or 15-minute time frame, to look for entries. Right now, I'm on the 15-minute time frame, and when it comes to looking for entries, we want to use price action, and we want to look for things like breaks of structure, support resistance, or trendline breaks, and we can use those as confirmations to open trades. Now, we can clearly see price tapped into the order block, and we could have used price action to open a buy position. Price formed this bullish rejection candle, telling us buyers are in control. So on the closure of this candle, we could have opened a 1, maybe 2-hour buy position. And I tell you what, if you look at the bigger picture, the trade would have played out very nicely. And let's just say you missed this opportunity. You'll notice price pushed to the upside, breaking structure / resistance above this pink trend line. And on this candle closure, we could have taken a 2-hour buy position, and the trade would have played out beautifully. At the end of the day, the more confluences you have, the better the setup. Every single concept I just mentioned, fair value gaps, order blocks, support, resistance, trendline breaks, breaks of structure, I've created individual videos on, which you can head over to my channel and watch for absolutely free. So I highly recommend, once you've finished watching this video, to go and check them out, to educate yourself, because it will take your trading to the next level. Let's take a look at another example here. After price formed this small pullback, we got another swing to the upside. So we're going to grab our Fibonacci retracement tool, And once again, I'm going to change the color to white, and we're going to mark out the bottom of the swing and drag it all the way to the top. In this situation, we get a pullback, but it's not below equilibrium. So what do? As long as price keeps going up, we follow it. And where's the next high? Right over here. Let's just drag this across. We know that price can't keep going up forever. What goes up has to come down. With a little bit of time and patience, we will eventually get a pullback to equilibrium. And that's exactly what happened here. Price started to consolidate and ended up dropping below the 0.5 retracement level into the discount zone. Again, with this setup, we have two confluences identical to the previous setup. I went ahead and marked out this fair value gap with this blue rectangle. And then down here, I went ahead and marked out this order block with this yellow rectangle. Price dropped into the fair value gap and all the way down into the order block. Jumping over to the 5-minute time frame, we clearly get a break of structure / resistance break above this pink trend line. And on this candle closure, we could have opened a 4-hour buy position. And if we zoom out, the rest is history. Next up, we're going to take a look at examples in a downtrend. We are currently looking at the Euro CHF pair on the hourly time frame, and the market is very much in a downtrend, forming lower lows and lower highs. We've got a lower low, lower high, lower low, lower high, lower low, lower high. You get the idea. Market structure is clearly bearish. Now, this swing to the downside was ultimately the beginning of this downtrend. We got a break of structure right here on this candle, confirming the trend reversal. So we're going to grab our Fibonacci retracement. And once again, I'm going to change the color to white. And we're going to mark out the top of the swing. And we're going to drag it all the way to the bottom. Now you'll notice we don't get a pullback to equilibrium. Price goes lower, we go lower. Again, we still don't get a pullback to equilibrium. So we keep going lower, and eventually we do get a pullback to equilibrium. We just kept moving with the price until we got that pullback above the 0.5 retracement level into the premium zone, where we can look for sells. Now, the interesting thing about this setup is that there is no order block, and price did not tap into the fair value gap that I marked out with this blue rectangle. All this means is that this is a weaker setup. It does not mean that we can't look for entries. We can still go down to a lower time frame and look for sell entries above equilibrium in the premium zone. I've just hopped over to the 5-minute time frame. And on this candle right here, we moved up into equilibrium, tapping into the premium zone. So we can start looking for sells. Then we get a break of structure / a support break below this pink trend line with this candle over here. So on this candle closure, we could have opened a 4-hour sell position. So we would have opened a position at 10:50 p.m. 4 hours later, the trade would have closed down here at 2:50 a.m. And that would have been a pretty solid trade. Let's take a look at another example. Here we have a swing to the downside with market structure forming a lower low. So we're going to grab our Fibonacci retracement tool. We're going to mark out the top of the swing up here. And we're going to drag it all the way to the bottom down here. And as you can see, we get a clean pullback to equilibrium, nicking it by a pinky nail. And believe it or not, a pinky nail is more than enough. We got that pullback above the 0.5 retracement level into the premium zone, which is exactly what we want. Now we can look for some confluences to make this setup even better. I've gone ahead and marked out this fair value gap with this blue rectangle we have here, And I also went ahead and marked out this order block with this yellow rectangle we have here. In this case, you'll notice price only taps into the fair value gap and not the order block. But having this confluence still gives us a lot more confidence with this setup. So now we can drop down to a lower time frame to look for some sell entries. Okay, so I've just switched over to the 5-minute time frame. And here we can see we got a nice push up into equilibrium above this white 0.5 retracement level, which means we can start looking for sells. Right here, we got a break of structure or a support break, whatever you want to call it, with this candle breaking below this pink trend line here. So on this candle closure, we could have opened a 2-hour sell position. And if we zoom out here, we got a beautiful continuation to the downside, and the trade would have played out to a T. Now, we've taken a look at some good examples of how we can use equilibrium in trending markets. We mustn't forget that we can still use equilibrium in consolidating markets. At the moment, we're on the Euro GBP pair, and we're back on the 4-hour time frame. And right before your very eyes, we've got a prime example of consolidation. Price is moving sideways. It's not moving in an uptrend, nor is it moving in a downtrend. And this we call a ranging market. Now, you guys will remember I mentioned that using equilibrium in a consolidating market is slightly different to using it in a trending market. So what I mean by that is if we grab our fib, I'm just going to change the color to white. We're going to mark out the top of the range, drag it all the way to the bottom, and stretch it out across, covering the whole range. Keep in mind, it doesn't have to be perfect. You just don't want your range to be too big or too small. Ideally, you want to pinpoint where the highs and the lows are and squeeze that within the range. You may find that price wicks above the range or even wicks below it, which is totally fine. As long as you've marked out the average size of the range, you should be good. Now, I'm not going to go too into depth here. The idea behind trading in a consolidating market is that you buy at a discount below the 0.5 retracement level and you sell at a premium above the 0.5 retracement level. So in other words, buying low, selling high. And remember, you still want to be looking for those confluences like order blocks and fair value gaps, jumping over to the lower time frames, entering positions of confirmations like breaks of structure, support, resistance, and trendline breaks. You get the idea. We did take a look at some good examples of how we can open trades earlier. I mean, I'm personally not a big fan of trading in ranging markets, just because there are a lot of fake outs and price could break consolidation at any point, forming a new trend. But I suppose you could apply that logic to trending markets as well. Price is trending in one direction, and then all of a sudden there's a trend reversal and price starts moving in the complete opposite direction. Look, I'm not saying that you shouldn't trade in ranging markets. That's just my opinion. Trading in consolidating markets has its risks. But if you look at the bigger picture, trading is risky. People, those were some sweet examples of how we can use equilibrium in trending and ranging markets. And just a reminder, you can use equilibrium on any time frame. But obviously, I do recommend sticking to the higher time frames. I'm going to be completely honest with you guys. I personally use equilibrium every single day in my trading, whether I'm trading stocks, crypto, forex, binary options, you name it. It's an incredibly underrated tool. It just makes sense. Buying low, selling high. Traders will often compare the Fibonacci retracement tool to equilibrium. They are very similar, but not the same thing. Equilibrium is a must. I highly recommend incorporating it into your trading system because it will take your trading to the next level. Just by sticking to the principles of buying low at a discount And selling high at a premium will not only improve your results and your win rate, but I can guarantee you that it will completely change your insight and understanding of the markets. But otherwise, I hope you guys found this video insightful, and most importantly, I hope you learned something new today. And if you did, go ahead and smash a like on the video and subscribe to the channel if you are new, and I will see you in the next video.